Like Victoria said, my name's Dillon Rosenhamer. I work with Surety Insurance Services, which we're the largest independently owned insurance brokerage in Oklahoma. We take care of a lot of federal contractors, ODOT contractors, general contractors, and subcontractors. We were fortunate to run our construction team there. So Paul Moore, myself, we've got a loss control guy, and then a couple other risk management people that are fortunate to handle some of our larger contractors. We're going to talk a little bit today about surety bonds. Has anyone in here ever had a surety bond before or tried to get surety bonding before? How was it?
Interesting.
Interesting, yeah, to say the least.
Yes, found the right company to go with, so.
Yeah. Well, bonds are a lot different than insurance, and we'll get into that a little bit. Insurance is a product. You know, when you need your workers' comp, you need your general liability, you need your automobile insurance, you go to your agent and you request the insurance policy be increased or added, and they do that for a cost. Bonds are more like a bank line of credit. You have to qualify for bonds. It's just like going to a bank and trying to borrow some money. It's a three-party agreement, whereas insurance is a two-party agreement. You know, bonds, and it kind of, I guess our first slide, we'll get into that. Our second slide somewhere. Okay, with surety bonding, you've got three different parties involved. You've got the principal, you've got the obligee, and you've got the surety. The principal is the contractor in the situation. So you guys, or the general contractors, the prime contractors, would be the principal in the bonds. You've got the obligee, which is the owner. That's who's requesting that you have bonds put in place. And then you've got the surety, who's essentially backing the bond. In case of contractor default, they'll step in and they'll help out. So we'll get into that a little bit more in detail. The reason of why bonds are needed is what's called the Miller Act. And that was originally the Hurd Act back in 1894. The Miller Act succeeded that back in 1935. And it basically says that any public project that is going to be bid to a general contractor, prime, heavy, road, street, we're building schools, we're building bridges, highways, we need to cover that with a bond. And that's to protect our taxpayers' money is what it is. You know, we don't want, if a contractor is to default, it's going to cost a lot more money to get another contractor to fix the mess that he made and step in and finish it. So rather than our tax dollars having to pay for that and continue just spend more and more money, a surety company steps in and uses their funds to finish the job, whether it be to help the contractor get through it, because it's not always the prime contractor's fault when there's a bond claim. It could be a subcontractor. It could be a material supplier went bankrupt. There's a lot of different reasons why bond claims can happen. But it basically protects our taxpayers' money, and it protects the prime contractor as well, and it protects the subcontractors. A lot of you guys, I don't know the capacity what everyone does in here, a lot of you guys are probably subcontractors, and you want to make sure you get paid, right? You know, you don't want your general contractor, the prime, to be taking all the money from the owner and not paying you guys. Well, bonds protect you too. You can call their bond to get paid, and we'll explain how that works. On the state and local level, Oklahoma has what's called the Little Miller Act. You know, we've got that in every state. The Little Miller Act means that any job over $50,000 is going to be bonded, period. But the Miller Act was put into place initially for $150,000 jobs. It changes very state to state. Typically, $100,000 is about the number that you'll see. Anything lower than that, they may or may not require bonds. They may require an irrevocable letter of credit. They may require a cashier's deposit or a bond. Bonds are typically the easiest because bond companies are built to pay. Banks are not built to pay. Banks are built to have a line of credit, and if for some reason they need to call that line of credit, they will find every reason possible not to allow that person to have that line of credit. There are three types of bonds. There's a bid bond, there's a performance bond, and there's a payment bond. There's also you've probably heard of maintenance bond, a defect bond, supply bonds. There's numerous other kinds, but these are the three big ones that you guys are going to deal with the most. When you're bidding a project, you're going to see all the time we need a 5% bid bond. You guys have probably all heard of that. That basically says that a surety company will issue you a piece of paper that says if our contractor is low and if they accept our bid, here's a bid bond of 5% of whatever their bid amount is. They have to agree to support final bonds in order to get a bid bond in place. So if you've ever tried to get a bid bond before, you're basically having to qualify for all your bonding up front. Because if you're low, you give them your bid bond, they come in and say, great, we accept it, now you need to give us final bonds. So you don't have to go back to the surety and say, okay, now we need to qualify for final bonds. They're going to qualify you before they give you the bid bond. The 5%, what that typically stands for, if your bid's $100,000, and you guys show up, give them your $100,000 bid, you find out at the end or right before you when you're awarded the contract, gosh, I missed 30% of this job, or I really, really underbid this thing, or we lost some of our big prime contractors that we work with, or some of our project managers. We can't do this job. You know, you don't want to go in there and know that you're going to lose a bunch of money on this job. So the 5% basically says that the surety will step in and pay 5% of your bid amount and let you walk. Now there's a difference in insurance and surety, like I've said. Insurance, they'll pay your claim, they'll slap you on the behind and say, you know what, we're going to raise your premiums next year. Sorry to hear that. Surety company is going to come back after you for that money. It's like I said, it's like a bank line of credit, it's like a bank loan. So they're going to come back after you, and we'll get into the indemnity of it here in a little bit. And then the performance bond is once you are successful on a job. You've won the job, you've got your bid bond, they've accepted your bid. You're going to be asked to give a performance and a payment bond, and typically a maintenance bond as well. The performance bond is what's guaranteeing that you perform the job correctly to the specifications that you have said to your prime contractor or your owner that you can do. If for some reason you said, yes, we can build this bridge to spec where it's going to be X high, it's going to have X amount of concrete, it's going to have X amount of rebar in it, whatever it says, and they come and find out that it's not structurally sound, they're going to call your performance bond and say you didn't perform your job right. You know, I'm sorry to hear that, but we're going to call your bond. Unless you can come out of pocket and fix it, which a lot of the times it's too late in the project, they're going to call your bond. Payment bond, same thing. That's going to protect the subcontractors and the suppliers. If you're not paying your bills, if you're not paying your suppliers, or if you're not getting paid, you can call the payment bond, and that just says we're not getting paid, period. And then the surety company will step in, they'll pay whoever needs to get paid, then they'll come back to the person that holds the bond. It says, okay, you didn't pay the material supplier, you didn't pay this subcontractor, we paid them, you got to pay us back now. And they will chase you till you die until they get that money back. So you can't avoid it. And we're going to try to go through this quick because I've got a lot of information here, and some of it we're going to get into the financial side of it, which is going to be the most important part. This is just kind of a brief overview of what bonds are and why they exist. This is the difference between bonds and insurance. I know we kind of talked about it a little bit. I'll let Paul, if you want to kind of take this over. He's more of our insurance guru.
Yeah, there's some key differences. As you see, I'm not going to go through and read each one to you. There's some key differences. You see the third one down, as Dillon mentions, a three-party agreement rather than a two-party agreement. In surety, it's project-specific. So you're going to bond a particular job, start to finish, and then that's essentially the lifetime of the bond. In insurance, it's term-specific. So if your renewal date is 10/1 coming up Monday, it'll run 10/1/12 to 10/1/13. It varies in that regard. And then also the claims. Surety has the right to contract balance and indemnity from the contractor, and the contractor remains primarily liable. In traditional insurance, there's no right to the insured's assets, however, companies can subrogate. So key differences between the two. Again, I think the most important thing to remember to take away from this is it's like co-signing a note. You're looking for a co-signer. There is a caveat that if for some reason you default, you can't make the payments, and the surety has co-signed with you, they have to make the payment. It's not, your mom or dad and they say, oh, I'll take care of it, son, and on down the road. No, they're gonna take care of it, and then they're gonna come back and say, okay, let's talk about this. You owe us whatever until you can get off of this job or pay what they paid, so on and so forth. That's one. Number two is it's project specific rather than full term policy as in traditional insurance.
Yeah, and I think one more pretty important difference between bonds and insurance is bond forms are standard. Carriers are going to have it. AIA bond forms, you've probably heard of different types of bond forms. They're typically, Travelers has their own, and Granite Re has their own, and Hartford has their own. They can be negotiated. If you don't like the term of one of the bonds, or not you, if the owner doesn't like the term of the bond, or the prime contractor doesn't like it, you can negotiate it. Tough to negotiate your insurance coverage. You try to go back to Travelers and negotiate, hey, I really don't like how you guys have your wording here on your subrogation. They'll say, well, okay, well, go find a carrier that does. So that's one of the main differences there. I wouldn't take a lot out of that because it's going to be very difficult to negotiate when you're going back to ODOT or going back to one of your big prime contractors that you don't like their bond form, but it can happen. So keep that in mind.
I got one more thing on that.
Yeah.
You know, I mentioned that if your surety has to step in and pay an obligation for you, it differs from insurance. If you take your loss runs in, your loss histories into a insurance carrier for general liability, work comp, whatever, and you present to them, you say, look, we haven't had a claim in 3 years, they say, wow, that's great. If you take your surety record before a surety underwriter and say, we haven't had a claim in 3 years, they say, yeah, well, why would you? Surety bonds are never intended, they're written with the intention they're never going to pay. If they've done their homework on you and you're financially stable enough, and Dillon's going to get into a lot more of the background of what they look at and what they look at when they qualify you, they don't ever intend to pay it. They're going to write the bond for someone at a level where they know you have displayed the capacity to handle that project and that bond.
Yeah, and that's it's a good point, because we'll get into some pricing of bonds, and it's, they can vary, but it don't vary too hard. Insurance is just a risk pool of dollars. We all throw our money in. Some of us take some back out for claims, some of us don't. You're always going to have to pay for it. Bonds, in relation to the size of the project, if you're doing $1 million job and the bond premium's 1.5%, 1%, they're pretty much hoping that nothing happens bad on that job, because it doesn't take very many bond claims to put a surety company under. Now, right now, the surety industry is running extremely strong because they're conservative. So the surety industry is as strong as it's ever been over the last 30 years, these last 4 or 5 years. And I know a lot of people are saying, well, the economy's been terrible. We've had a lot of contractor default. That follows. So for the next 24 to 36 months, we're going to start seeing some sureties having to pay some more bond claims. That is going to make them a little bit more picky and choosy who they decide to start bonding. They've already kind of started that, knowing that that's going to happen. So this takes us into this next slide here is let's talk about how we get bonds. The role of the producer, the role of your insurance agent and your bond agent. It's a little bit different. You don't want to get it too confused. Your insurance guys will know about bonding, and they'll know a little bit about insurance. You really want to be with someone that knows a lot about bonding, because if you just package a deal and say, here's what we need, and the producer goes and turns and gives it to the underwriter and says, hey, XYZ Construction needs a bid bond for this project, can you do it? The underwriter's 99% of the time going to push it back and say, why should I do this? You need to sell it to me is why we need to bond your contractor. So there's a lot of role that needs to be done beforehand, before you go and try to get a bond. So take this out. If you're bidding a job tomorrow, let's get the bond company involved 2 and 3 and 4 weeks ago, or a week ago even. Let's not try to do it the day before, because no one likes to scramble around and try to get bonds last second. The role of the producer is basically, you've got your contractor. You guys are the big, nice red circle in the middle. You want to have a team around you when it comes to bonding projects. You want to have your attorneys involved, and I'll explain to you why we'd like to have attorneys involved. And you want to have your lenders involved. Go ahead.
Is there a bonding for consulting?
Say that again.
Is there bonding for consulting, like design or consulting work, not contracting?
Engineering and the like.
Engineering work, right?
If it's required, if it's a large enough type engineering consulting job in the state.
Do you have experience to sell bonding for consulting?
Sure, yeah, I mean, you can, now more insurance, I'm sorry.
Could you repeat his question, please?
Oh, the question is there bonding for consulting and engineering type services? If it's required, absolutely there is. Now, there's insurance products that really cover that more. It's more like professional liability type insurance. But if it's required, then yeah, if a bond's required for something, a surety will write it if you qualify for it. We'll put it like that. So yeah, there is, if it's required. Have you been asked to bond a consulting or engineering type job before?
No, but the price difference is so big that it'd be better to have bonding
Mm-hmm.
in certain type of work
Mm-hmm.
instead of buying insurance, which is like too much.
Right, and that's what professional liability insurance is for, unfortunately. I mean, is that what you're kind of looking into?
Professional liability.
Yeah.
But also we have insurance for.
Yeah. A bond's never going to take the place of insurance. Bonds are there because they're required by your owner or your obligee, that they're requiring to bond the project to protect them. So you can never really go to them and say, hey, rather than us providing a professional liability insurance policy, we'd like to give you a bond instead. They're going to say, unless we require you to have it, then you can't really trade it out, unfortunately. That's what different products are for. So back to the role of the producer, we want your lenders to be involved. We want to talk to your bankers. We want to see, how's your bank relationship been? Have you been up to date on your current lending? Have you, what kind of balances do you keep in the bank? We don't care exact, but Are you 6-digit balances? Are you 5-digit balances? How long have you known your banker? Tell us, I mean, have you always been in good standing with the bank? Because again, bonds are extremely similar to commercial loans. I was a banker for 8 years before I moved over to do bonds, and it's eerily how similar they are on the underwriting. In banks, you look at what? Collateral, credit, and cash flow, right? Those are your biggest thing in banking. In bonds, they don't really care about they don't care about collateral, first of all. And there's some bonds that take collateral, and in some of the smaller projects and smaller bond companies and emerging contractors might look into having to do something like that. But they look at capacity. You know, how much work can you do? How many employees do you have? Tell us about your biggest job you've ever done. Tell us what kind of working capital you have. How much cash do you have in the bank? How long can you cover overhead if something were to happen today? How long can you cover overhead? Because bonds are going to be on the hook for not just the duration of the job, but the maintenance might carry out 2 or 3 years after that too. And then they also look for character. You know, give us some references. Who have you worked for? You know, if you've worked for XYZ general contractor, we want to call them and we want to know that you've done a good job with these guys. Those are big deals. And then, okay, so then you've got your producer that's going to work with all these guys too. So you might find bonding, especially the first bond that you go after, is a little bit invasive because we're going to be asking questions. We're going to be asking stuff you've probably never been heard before, and especially that your insurance agents ever asked you before. So get ready for that. You know, they want to know continuation planning. You know, if it's just you and your brother that own, you know, Smith Brothers Construction, what happens if John Smith gets hit by a truck tomorrow? Is the other Ron Smith going to be able to take care of these jobs that we're bonding right now? I mean, it's questions that you've probably never been asked before. So they want to know about continuation planning as well. Once your producer, you know, your bond producer gets all this information and compiles, you know, the financials, which we'll get into that in a little bit, and compiles a story for the surety, then we'll go back and represent you to the surety. We don't want you guys going and represent, because we know the questions to ask, we know what to bring to the surety, and we know what to say. We know why you guys would be a good fit for the surety. And then, like I said, we'll go to the surety company when we talk to you for it, or your bond agent will do that. Pre-qualification for bonding, these are some things that you're going to be asked for up front. We want to see your financial statements. We want to see at least 3 years of year-end financial statements if you have them. Now, whether that's in-house, whether you've got a CPA compiled statement, if you've got a reviewed statement or an audited statement. I'm assuming a lot of you guys probably don't get audits right now because you don't have to. Audits are expensive. Reviewed statements are pretty expensive. You don't want to do that. Compiled statements, where you just have your CPA compile your statement on an annual, quarterly, or semi-annually basis, that can get a little bit pricey. But that's going to help your ability to get bonds. The more quality of a financial statement you can show the producer and the surety, the better chance that you're going to be able to get bonding, because they know that you've taken care of your finances and that you're having someone help you with your finances, a CPA or an in-house controller that's really doing a good job for you. Because the only thing a bond company can go off of is what you show them on a piece of paper. It's a financial guarantee. So they have to trust and believe what's on that piece of paper. Is anyone here, I mean, you guys all run an in-house QuickBook type statement, something like that? Is that predominantly how everyone runs their books now? Okay. That'll work on some of your smaller type bond needs, you know, typically up to, let's say, $500,000. That's okay. Now, if you have a bond program where you need a single job of $200,000 or $300,000 or $400,000 and you've got another job of $300,000 or $400,000, you need a bond in another month, you might want to start considering getting a compiled statement from a CPA. And all that means is a CPA comes in once a quarter, once every 6 months, takes what you have, what you've put together with your own QuickBooks, and they look at it and they try to look to see if there's any disparities between what your receivables are showing or what your work in progress is showing and what you show, and then they'll sign off on it and say, yeah, we've looked at this and we feel like that they've done a pretty good job doing this. So if there's problems, come talk to us, not them about it. So sureties love to see that. Capacity. They want to see, like I said a little bit earlier, what kind of capacity of work can you do? Not, if you've never done $1 million job before and your biggest job's $150,000 and you want to bid that $1 million job tomorrow, that's going to bring up a capacity issue. They're going to say, well, can you, we don't want to insult you, but can you do that $1 million job? Have you ever done a $1 million job before? Do you know what comes along with all this? Go ahead.
And that just speaks to really nuts and bolts issues: manpower, equipment, trucks, all those things, the mechanics of completing a job in capacity. And it's, they may want to look at what your equipment inventory is, your manpower is, expertise of your project managers, things like that. So it's really It sounds a little nuanced, but it's really not. It's nuts and bolts.
And one of the biggest hurdles that we have and the surety has is we've got to sometimes step into a business and tell them, no, you can't do this job. And they say, well, okay, here you are sitting behind a desk in a computer in your little loafers and your tie and telling me, the contractor, that I can't do this job? What do you know about pouring concrete? You know, what do you know about putting up guardrails? We don't. But here's what we do know, that the surety has to financially guarantee this project. So they're not saying physically, you know, you don't know how to do this job. It's unfortunately, we can't support a job of this size for you because based on the financials and the history, it's very, very difficult for us to put our money back behind this. Organization of the company, I kind of said that a little bit earlier. They want to know who is the president, who's the vice president, who's the successor. You know, tell us about your best project manager. Tell us about the new guy you just hired. Tell us why you just fired this last guy. What kind of controllers do you have in place? References, we want to call some of your references. We want to see who you've worked with in the past. And then credit history. They're going to take a look at the owner's personal credit. They're going to want to see, you know, and as well as the company credit, how you're paying your suppliers. But they're going to want to see that you've taken care of your own business as well, because again, in the less than 1% of the time that a surety actually does have to step in and pay a bond claim, and there is money out that they have to come and try to collect or try to work out over time, they want to make sure that they're dealing with someone that should be able to help them out in that situation. So there's a lot of upfront work before you just go to a bond company or a bond agent and request a bond. That last one was bank relationships. I don't know why they didn't pop up. Financial statement analysis. We'll get into this a little bit more here in a little bit, but the biggest thing's your balance sheet. The balance sheet and the income statement. Bond capacity is based on your working capital. Have you guys heard all what working capital before? I'm sure someone's told you, you know, working capital. You need to increase your working capital. Working capital is just basically your current assets minus your current liabilities. Whatever that number is. Your current assets are going to be your cash and your account receivables and your CDs and your marketable securities. Anything that you can basically turn into cash within a 12-month period is considered a current asset. There's another current asset on that's called underbillings, which I don't know if you guys get to deal with those very often, but we'll talk about why that is not the best current asset in the world. Over your current liabilities, what are your debt obligations over the next 12 months? What's your account payables? What's your short-term borrowings, your credit card debt, you know, your line of credit that you've got that's only 12 months? They take that number, they subtract it, they do a little bit of in-house adjustments because, you know, they'll adjust down for some of your securities and they'll adjust down for some of your receivables. If you've got a receivable out there for $250,000 that shows up on your ARs and it's been showing up on your ARs since last July, they're not going to be able to count that. That's a dead receivable to them anyway, because they know that there's a good chance that you might not collect all of that. Account schedules, cash flow statements, those are important. You're probably not going to have a lot of cash flow statements if you're doing in-house, but that as we start to get to bigger bonding needs, they're going to want that. Your account schedules, we'll get into that. Your work in progress, that's extremely, extremely important. And I've brought an example of a work in progress page that we built that we'll send you guys if you'd like to start utilizing it. If you can go into a bond relationship with a good work on hand schedule, and we're talking cost to complete, percentage completion, here's our initial bid, here's any change orders that we've had, here's our cost to complete now, here's where we're in the project. That is the most important thing you could do in the world to secure bonding. All that is, you know, basically makes up what the financial statement they're going to be looking for. These are just different parts on the financial statement, which we kind of already went over. So. Management letter, they want to get a letter up front from the guys. Just give us an idea what your business is. Tell us about the management. Tell us about the history of your business. You have to build a resume as to why you want this financial guarantee. Benefits of bonds, financial security, and this is more for the owner. It's financial security for them. They've got a lot of money and time invested in whatever project you guys are building for them. They've got to be protected in this deal, as do the tax dollars. And then construction assurance, making sure that they have picked a right contractor to do the job. A bonding company stepping in and saying, yeah, they can do this job. And that's the most important part. Go ahead.
If you have a bonding, which let's say it's 50,000.
Uh-huh.
And during the construction you have 2 change orders
Mm-hmm.
for 25% more.
Mm-hmm.
Is that automatic bonding that you guys provide? Or
The bonds will increase.
all over again?
The bonds will increase. No, you don't have to go back and requalify. Now, if it's a $500,000 job that we've qualified you for and you had your first change order is $490,000, now it's $1 million job, we might need to talk. And the question was, I'm sorry if we didn't pick this up, if a change order happens during a job, do new bonds have to be produced? Typically not. Jobs are audited throughout the process. Let your producer know that there's a change order. We'll let the surety know. They'll be happy to bill you for that difference, because they will. Unfortunately, the price of the bond at $50,000 and the price of a bond of $100,000 is going to be a little different. So they'll come back and they'll audit the job as it goes. And that's going to be through your job schedules that you need to be giving your producer, your bond agent, your surety on a monthly basis, quarterly basis, however you want to set it up. Anyways, more functions of bonds. You know, when we're working on a public project out there and we're building a highway and you don't get paid, guess what? You can't go file a lien. You've probably all figured that out by now. There's no liens filed, so that's what bonds are for. You're going to be able to collect on that. Create a smooth transition from construction financing to permanent financing. That's more on the owner's side. A lot of times banks require bonds. If I'm the banker and you're going to build a $25 million apartment complex on my dime, and you've chosen, you know, I'm the banker, you're the owner, and you've chosen XYZ Construction to build it, I'm going to come back and say, you know what? Let's bond this project because it's my money in this deal. I mean, I know that you're going to be the owner of this deal, but I've got my money invested in this thing. So let's make sure and bond this project. Provide support to all the contractors. You know, the prime contractor, you know, unfortunately carries the bond, so he doesn't get all, but everyone else underneath him does, you know, to avoid liens, and then to ensure that the project's completed on time. You know, the bonds follow the contract. The contract says this thing needs to be done in 180 days. It needs to be done in 180 days. Now, the bonds will give you leeway. The sureties will give you leeway. They're not going to just hammer you to death, but they will make sure that you're on top of it. And bond companies are good about reading your contracts, maybe sometimes thicker than some of our contractors read the contracts, because we'll come back and say, did you know there was a $1,500 a day liquidated damages on this project? And they kind of look at it and they're like, really? That's $1,500, and that might change the bid a little bit. All of a sudden they might bid that they'll get it done in 200 days, not 180 days. So that could eat up margins real quick, as you guys know. Let's get to the next slide here. We're trying to get through this. Bond claim filings. This is pretty important. I actually added this morning. It was not part of the initial slideshow, but I think that this is probably the most important part. Who can file a claim? It's different for every state. Subcontractors, material men, and those under the contract with subcontractors can all file a claim. Bonds are typically only go 2 tiers. They're going to cover the subcontractor and a material. Oklahoma's different. We actually have the ability to people can file claims that are sub of a sub of a sub of a sub. Now that scares general contractors to death. The fact that, so they're going to come in a little bit tighter and say, well, we'll hire you to be a subcontractor and that we want you to come and, you know, do X, Y, and Z for us. But who are you going to hire to come and help you do your job? And who are they going to hire to help do their job? Because just because you're getting paid and you're paying your direct subcontractor that you might have, they better be paying their material contractors and their suppliers, and their suppliers they better be paying their guys, because any of those guys can file a claim. Now, it's a little bit more stringent on that. They've only got 90 days to file a claim. A sub of a sub has 90 days. So know that. If you're ever a sub of a subcontractor in a deal, you have 90 days to file your bond claims. And that means 90 days since the last time you provided labor or materials to the job site. So if it's been 65 days and you haven't seen money, get a letter, certified letter, send it to your general contractor, send it to your subcontractor, and send it to the surety company and say, I'm notifying you I have not been paid, or the performance was not done how we expected it to be done. I'm not saying we need to get paid right now, but I'm notifying you, because if you do it on the 91st day, sorry. Yep, exactly. Now, if you're a direct contract with the prime contractor, if you are the sub of XYZ Construction, you've got a full year to file. Because, you know, typically they're longer projects, and if you're a direct sub, then you're going to be working probably more than a sub of a sub of a sub of a sub. So you have a full year and after the last bit of service or labor that you've given that person. So keep that in mind. You don't have to memorize that today, but if you're in a project and you're the sub of a sub, get with your bond producer and start asking questions after 35 and 45 days, because I can promise you that'll get you paid. The prime contractor does not want a bond claim. Once they have a bond claim, then the bonding company completely changes their mind about that contractor they've taken on. And then finally, and we've got another one here, don't worry, we've got plenty of stuff to talk about. The cost of surety bonds. Bid bonds are free. You know, if someone's trying to charge you for a bid bond, find another bond producer. Bid bonds are free. If I charged my clients for bid bonds, I would do it exactly one time, and that would be the last time I got to provide bonds to them. The performance bond is going to vary based on the type of work, based on your experience, based on the duration of the job, based on all those pre-qualification things we went over is going to be the difference in price. That 0.5% you won't see. I can promise you that. No one sees that. Even your $100 million a year contractors, we write some really big contractors, they don't get 0.5% bond pricing. 2% of the contract price is probably more like what you'll see on some of the smaller jobs. You know, go ahead.
Performance bond, you have like a formula, or it's kind of subjective when you decide it?
Are you talking about for pricing?
Yes.
There's standard rates. There's like Texas, for instance, has standard rates. There is no difference in rates. Texas has a standard rate, period. Everyone gets the same rate. It's $25 for the first, it's $25 per thousand for the first $100,000, and it's $15 for the next $400,000. Then it's 10 over and over. Whereas Oklahoma, we don't have standard rates. We have standard rates filed, and a lot of the bond companies go off standard rates. As the larger the work program is, if you've got a $50 or $100 million work program, you're making the bond company a lot of money. So they're going to start bringing the rate down a little bit. You might only pay, 75 basis points, 0.75% on your jobs. But here's the thing about bonds that we cannot stress enough. Bonds are job cost. You don't pay for bonds. Your owner pays for bonds. The obligee, the person, the contractor you're doing work for that required you to get that bond, they're paying for the bonds. Add it in your bid. When you're bidding a $100,000 job, bid $102,000 and tell them this $2,000 is because you required me to get a bond. So it's a job cost. Don't think that it needs to come out of your profit margin on these jobs. So remember that. It's a job cost, and it's as much as, because we get a lot of slack. Well, gosh, you're charging us $2,500 for this bond. Well, I'm not charging you. It's a job cost. Go to what about your steel guy? That's a job cost, right? Exactly. Bonds are job costs because they required you to do it. We didn't require you to do it. Your owner did.
So is it good just to add that price with your bid before you even
With
the project?
The question is should you just go ahead and add that in? Well, absolutely. I mean, you want to add in all of your, when you're bidding a job, you look at all of your general administrative expenses. You look at all of your subcontractor expenses. You look at all of your supply expenses. You look at everything. You want to look at what are your bonds and insurance costs for this deal. You might have to have some project-specific insurance policy, or you might have to have some, some kind of, owner-controlled insurance program for this one exact project, OCP policy, whatever it is. Am I saying that right? OSIP. Those are going to be additional job cost. So don't let that eat into your margin. I mean, if you're used to making a 20 or 18 or 14% margin, don't say, well, gosh, minus the bond cost, we're only going to make 12.5% margin. No, it's a job cost. It's an absolute job cost.
And the company's responsible. Now, in my case, I'm in the trucking and freight business. So if I'm supplying somebody with materials for the job, am I required to get that bond, or am I protected under that prime's bond order?
Say that one more time. Now,
If I'm supplying them with materials for the job, am I required to get bonded too?
No. You're not required to get bonded unless they require you to get bonding. It's not. You don't. If they tell you we want, because you're a supplier, so they say, okay, well, we need it's going to be how much are you supplying? Are you supplying $1 million worth of stuff, or are you supplying $50,000 worth of stuff? If you're
say 50,000.
50,000. Well, they might come back and say, we feel like that you're supplying enough product that we'd like a supply bond from you. And that's a different kind of bonding, and we won't get into, we're talking contract surety today, but supply bonds, absolutely. Go to your bond producer and say, hey, I'm going to have a supply bond on this $50,000 worth of material that I'm supplying to the job. What's that going to cost me? And they'll say, well, it might cost you, $1,400. So now your bid, instead of $50,000 and $500, now it's $50,000 and plus $1,400. Add that to it. It's a job cost. They're requiring you to do it. Yeah. Don't ever let bond cost eat into your margin, because they're requiring you to get it. Yeah. Look at it as if they come back and say, okay, you're doing a park job, a trail job for us, and we want you to plant 7 trees over here too. You're going to go and price what those 7 trees cost, and you're going to go, that's part of a job cost. So include that, and don't say, well, we'll just eat this in our margin, because the majority of the job is going to be this little paving job. It's a job cost. Yeah, I can't say it enough. Did I tell you it was a job cost? Yeah, okay. Okay, well, that's it for this first little short one. The next one we're going to get into of how to build a good bonding relationship. And that's kind of bonding 101. This is kind of the meat right now. This is the most important part. And I'm going to see. Here,
You change that out.
you can talk to me for a little while.
Let's do a quick survey. As far as what? Okay, I know you're in trucking and material supplies. What other industries are you guys in?
We're engineering services.
Engineering services. What's your typical jobs?
We do QC, QA for civil work and geotechnical engineering.
Okay. Like geothermal?
No, geotechnical.
Geotechnical.
We study on the ground.
Okay, got it. How about you guys?
Construction,
Construction, general construction?
yes.
Okay. Typical job is what?
Storm sewer and concrete paving,
Okay.
pretty much dirt work and, all related.
Okay.
Okay.
Okay, you're with him. How about you in the back?
Oh,
Oh, sorry. Your job
You've got
is
the
to
worst job in
yeah.
here.
You've got a job
Everything I said about
that
ODOT,
nobody
I was
else
kidding.
wants. Yeah, we take all that back. And you, ma'am?
Land surveying.
Land surveying. Okay.
Yeah. So, I mean, a lot of you guys in the engineering side and the surveying side, you probably don't see a lot of need for bonds, right? But you're still extremely intrigued by what we're saying, so that's why you're staying in here and listening to it, correct? Don't answer that question, by the way. Okay, this is very important for the construction guys and the guys that are trying to build a good bond relationship. And we'll go through this quick, but this is important. We already went over a lot of this stuff. We're not going to do this part again, which is the difference of what are bonds, difference between insurance and surety. Third party, two party, risk transfer, both are the same thing. The duals to the owner, the obligee, whereas the risk, in insurance, you're the one that benefits from that. We don't need to get any more of this. Three-party relationship again. Stages of a lasting surety relationship. You need to meet, you need to maintain, and then the maturing part of the relationship. You cannot hear enough of how important it is to meet with your bond producers, meet with your surety. Don't expect them just to be able to get you bonds because you're a great guy or because they've written your insurance for 10 years. That's not going to get you bonds because they've written your insurance. What's going to get you bonds is that you're staying on top of your bond producer and saying, look, hey, we're looking at bidding a job in 75 days or 60 days or 14 days, and it's going to be maybe $500,000. Tell us a little bit about what we're going to need, and here's what we're working on now, and here's our work on hand, and this is what we're working, and this is what's going on. Here's a hiccup we had on this last job. I mean, just keep everyone involved as much as possible. The slideshow says meet once per year. That I strongly disagree with that. Meet a lot more than once per year. When your financial statements are available, send them out. Whether it's if you do them quarterly, monthly, semi-annually, or annually, make sure your bond producer and your surety get your financial statement as soon as possible. In your meetings, include your CPA, your CFO, or your controller. Because you know how to build a bridge, and you know how to build guardrails, and you know how to survey a job, and you know how to engineer a job. Your controller and your CPA and your CFO really know how to manipulate your balance sheet, and they know what you need. Hold on, what did we miss here? Sound financial statements, underwriting considerations for surety. They want sound financial statements. They want committed and competent personnel. They want you guys to be as committed to your financials as they are to having to read your financials. The guys that come in and say, well, why do you need to see this? That's one step back they're going to take. Well, why do you care, what happens if John Smith gets hit by a bus tomorrow? Why does that matter to you? They're going to take another step back, So just be ready to be open with your surety. You're not going to care what they had for dinner last night, but they're going to ask you a lot of stuff about your company. What's your business plan? What's your personal and corporate indemnification? Are you okay with that? Going into a bond, going into a project, are you okay knowing that you're going to have to probably indemnify this thing if something were to happen? Maintain your relationship. Keep it open, communication. Tell them if you're having problems on a job, let your bond producer know, hey, this job's not going as well as we planned. So then we can go back to the surety and get it taken care of as quick as we can. Say what you mean, do what you say, show results, no surprises, meeting obligations, be accountable. I mean, all that you can't stress enough. What's going to happen from your surety? They're going to be as open to you as you are to them. If they have a change in your capacity, if you're used to bidding a $500,000 job and you've got a $2 million work program and they've decided your financials don't merit that anymore, they're going to let you know. So they're not going to leave you hanging out to dry to go show up for some bid, and then you come back and they like, I don't know why you went to that bid. You can't bid that job. They're going to help you in assistance. They're going to say, if you're having problems with a job, here's a couple of light contractors that we also bond that might be able to help you guys out. Joint ventures is another thing. If you guys have ever done any joint ventures before, they'll recommend a joint venture partner for you that they've bonded, that they know is a strong bonding candidate. And then, kind of referrals on other contractors is kind of what we went into there. Job status report. Make sure that you keep your job status reports up to date. This is the number one problem in bonding that people do not do. And I've got a copy of one that I'm going to show you guys here in a minute. Provide bi-monthly or quarterly how your jobs are going. Are you winning money on jobs? Are you losing money on jobs? Did we overbid, underbid? I don't know if we've ever overbid a job. That's probably a bad idea. Reflect all the jobs undertaken. Don't just put on your work on progress. Don't lie on there, and don't say, yeah, we're only doing these 3 jobs. And you got to tell them about that other $500,000 job you're doing too. They want to know. If they find out, they're not going to be happy. And then provide consistent and conservative evaluations. If you really feel like a job might be losing money, or something's going to happen on a job, or you've incurred a lot of cost that you can't go and bill for, therefore you've got a lot of underbillings on a job, be honest with your surety and tell them, look, yeah, there's issues on this job, so what do we need to do to get through it? The role of the job status report is going to just track your work history. How have you done on your jobs? Going forward, show patterns. Are you typically overbilled the whole time? Are you typically underbilled the whole time? And it reveals how you guys communicate to the surety. I mean, that's just as much. It's not just a one interview up front. We'll get you bonding going forward. It's an interview every single time you talk to your surety and your bond producer. Questions the surety will ask. Are there large costs and earnings in excess of billings? Is your gross profit holding on this project? Have you guys had problems collecting your funds? Your progress billings. Have you overbilled or underbilled in this project? If so, then why? Why are you so overbilled on this? That's it. And we'll get into what the difference in over and underbilling of a project is. Are there any approved change orders that you need to do, but they've been unapproved, but has to be done? That's just going to eat right into your margin. And if a job's complete, when you show a job 100% complete on your work in progress and still open, bill for it. Get it off there. How come it's not been billed fully? Are billings in excess of cost? Overbillings. Are you guys familiar with what overbillings are? I mean, when you guys try to basically job borrow, when you go and say, look, we're gonna bill for work we haven't done yet. That's not a bad philosophy to do. I mean, sureties don't mind if you do that. We don't mind if you do that. You better prove why you're doing that and show it in reflective of your cash balance, because if you go and overbill a job by $100,000 and it gets approved somehow, then that $100,000 or something close to better be sitting in your bank account, because if now you've got $100,000 of their money that need to be going towards working for labor and materials and all this. Well, if you don't have that money anymore, then that you've front loaded that job pretty heavy. So for the next 6 months or 3 months or month or however long it is, then you're going to be basically funding it out of your own working capital, and it's going to diminish your working capital position. And do substantial overbillings reflect a strong cash balance? I mean, that's just what I said. If you've overbilled $100,000, show us where that cash is. Is your profit margin holding? Is there a pattern of profit fade? These are all how you build jobs will surprisingly reflect the profitability of your jobs and how you've done it over the last year, 2, 3 years. It shows the surety a trend of what your profits are going into a project and what they are coming out of a project, and is it because it's how you built the project? Go ahead.
And I would say about that, the role of the bond producer is sort of like an attorney. You see legal shows. If you've ever been in the courtroom in a legal proceeding, you don't consult with your attorney and then you stand up and do all the talking in court. The attorney does the talking because you're running everything through him or her, and they're filtering it through and putting it in a palatable language or pattern of presentation for the court, because that's their expertise. And so, and they don't want any surprises in court to find out, something that the client told the attorney wasn't exactly right, and now they get on the stand and they get melted down. So with your bond producer, if a job's not going right, like Dillon said, be up front, call and say, hey, this is, gone south or whatever. You won't be the first. It won't be the last job that may ever happen, and you would hope so. But there's nothing tragic about that. But I can't emphasize enough to be open, completely transparent with your bond producer, because they will run interference for you, and they will take your particular circumstance to the surety and represent you the best that you can be. So they, just like the attorney, they don't want any surprises. We don't want to find out, oh, you said this was going along and it was 75 and it's percent and it's not. You don't want to find that out.
Yeah, some common perceptions of surety bonds. A lot of people think they're evil. We shouldn't have these. It's like insurance. Well, the surety wants contractors capable of completing a project. That's the perception. The surety wants good, competent business persons to just show that they can do it. They want to make money. They want you guys to make money. Guess what? If you guys weren't making money, neither are they. So they're on your team. I mean, it's what is it? It's a job cost, right? Have I said that yet? So they know it's a job cost. So they're saying, look, we want you guys to make money. We want to continue to bond your work going forward. The surety wants the contractor to fulfill all the contractor obligations. Well, it's a perception, but of course that's probably true as well. But the surety wants the contractor to generate income by fulfilling their contractor obligations. And we want you guys to make money. I mean, we want you guys to stay in business so we can stay in business. No failures lead to increased surety capacity. Well, gosh, Dillon, Paul, I haven't had a claim. You guys have been bonding me for 4 years. I've never had a claim. You tell me I can't go bid this $1 million job. I've never had a claim. We understand that. You never had a claim, but you've got to build your balance sheet to get to that $1 million. That's the biggest thing. So the ability to grow your business and generate revenue leads to increased surety capacity. It's not just because you've never had a claim. It's a work in progress every day. The bond producer, the primary goal is to prevent default. That's our job too. We, surprisingly, as much as we probably don't look like it, we do know a little bit about some construction jobs, and we know how, at least on the billing side of it, and at least on the management side of it, we've seen enough of them, and we've seen enough good jobs and enough bad jobs where we can help out when we can. We help make the decision. Go ahead. And please don't ask a question about a job, because I'm not going to know.
Have you ever had a case of overbilling?
Uh-huh. You usually do?
No, you. Have you ever had a case, and how do you check that's not overbilling?
Okay.
That should be corruption.
Yeah. Well, okay. The question is overbilling. Are you saying do we see it? Do we see it a lot? I mean, it's really up to what the owner will allow you to do. Is what it is. It's not. It's a normal. I mean, we see it all the time. I mean, overbilling is not a bad thing. I mean, overbilling say, look, and here's a perfect example of how a job could be overbilled. You start a job on December 5th. Well, you can't go. You can't. You start a job on December 5th, and you know that your first billing is going to be for your insurance cost and your bond cost, your mobilization cost. Well, you can't bill these guys again until January 15th. And they're going to say, look, first billing is after the next year, so you're probably going to overbill a little bit. You're going to bill for work you haven't done because you've got to get through the end of the year. You've got to get a little bit of money to help work through it. Now, as long as the owner or the general contractor you're overbilling doesn't really come and check hard on that to make sure, but they'll approve it a lot of the times. If you're a good, competent contractor and you've worked with these guys for a while, they'll let you get a little overbilled. It's not, and if on real short jobs, you might, if it's a 45-day job and you knock it out in 30 days, your first billing might be for the entire project. Who knows? Now you've got 2 or 3 weeks left to work, but you've overbilled.
If it's a prime that you've just finished 5 projects with and never been a payment problem, they may just say, that's fine. I understand why you're doing it, and that's fine.
Don't tell them you're doing it.
I used to say I never did it.
Yeah, no, it's good. We don't recommend it. Don't think that we're not saying that, but it happens. It happens.
It's a monthly statement, a monthly estimate.
Right.
1 cent goes over the item.
Right. ODOT is pretty good about keeping on top of the progressive billings. There's much more over and under billings between a contractor and a subcontractor, between a prime contractor and ODOT, or someone directly contracted with ODOT. ODOT's learned how that works.
The way you should do it, work done, work approved, work paid.
That's work done, work approved, work paid. That's the philosophy that everyone wants to see. And I'm going to show you on a work in progress here. I'm going to show you an overbilled job, an underbilled job, and a job that's billed perfectly. Yeah, and how the surety perceives that. Again, we want to help extend surety capacity to ensure success of the contractor. We want you guys to do just as well as you can. I mean, we don't. The more money you make, the more money the bond company makes, the more work it lets us do for you, the more success we see, and that's what we want. And it's good for the state. We want to make sure that the jobs are getting in. And our tax dollars are being protected too. We don't want to have bond underwriters coming in and paying claims. We want trust, we want communication, timely reporting, teamwork. We can't stress that enough. And then if you want more information, you can get with anyone. But there is a pretty good NASBP, Surety Information Office. ODOT's got some good information that you can get more information on bonds for, but don't do the homework yourself. It's going to look like a foreign language a lot of the time if you just try to go online and read about bonds. Get with someone that knows a little bit about it and just ask. You know, a lot of the questions, there's no dumb question in bonding, trust me. If there was, we'd say we've heard them, but there's not. Here, let me pull up. Go ahead. Put you on the spot there.
I already know what everybody does. Yeah. So this guy walks in. No, I'm not going to do that.
Okay.
This is the.
Yeah, you can explain what this is. This is just kind of a pre-qualification.
This is the pre-qualification questionnaire. It's about, what is it, 4 pages?
Yeah, 4 or 5 pages.
4 or 5 pages, and it's going to go through. We've talked about everything that the surety wants to know, and this is our form that we've essentially built it from the ground up. So we're going to try to skip around all the stuff that's going to waste your time, that the surety doesn't care about, and get to the heart of the matter. This is one time. This isn't an every year or an every bond thing. This is basically, I'll give you a sort of paint the backstop against which all this is painted on is, once you get established with a surety, let's say it's CNA, Travelers, whoever, you're going to fill this out. They're going to look at your operation. From that point on, just like we're saying, they're on the same team with you, and they're going to ride with you. So there's not going to be a lot of ongoing things unless there are some changes along the way that they're going to need to update. But that'll all go through your surety producer.
And talk about a little bit, and you can tell. Well, I'm going to pull, but talk about shopping sureties. You know, it's something you really don't want to do. You know, once you get someone on board, stick with them.
Yeah, and that's we say in the business, you know, that your property casualty agent, and we do both, so we see both sides of it. Is you know, people will date their property casualty agent. They'll even have a very committed relationship to them. Some are long term, and we've got some of those. But you want to go into a surety relationship with the idea of, I'm going to marry this surety. This is till death do us part. As long as we're rocking along and we're seeing the growth and we're showing them, and they're supporting us by, you know, rewarding that growth, and we want to increase our capacity, and we can prove that we should, and they give it to us. There's no reason to ever break that. And
because the rates are so similar in surety that it's you don't want to go shopping surety rates. First of all, don't ever go into a surety type situation with your producer or with the surety and say, okay, we need to bond this project. What's your rate? That's the last thing you want to ask, because the rates are so. Is that it? What's that?
School's out.
Okay. Well, hey, thanks for coming, guys. I'm just kidding. We're not doing it. The rates are very similar. They're all within a couple of basis points. And remember, it's a job cost, right? So
that may be indicator number one, that a surety says they're looking for the wrong reasons.
yeah.
That may not be a good client for us. So.
Yeah, the surety wants you guys as long-term relationship as they do. Now, you might get lucky and outgrow a surety. That happens all the time. There's sureties built for $1 million work programs, and there's surety built for $100 million work programs. The goal is, the reason you leave a surety is because you've outgrown that surety. They say, you know, John, we'd love to continue to bond you, but you have gotten too big for us. That's great. That's what our goal is, to get you there. Anyways, back on this questionnaire. You see some of the questions we kind of talked about a little bit. You know, key personnel. Let's talk about who's the percentage ownership. You know, how long? Tell us about who you've worked with. Shareholder. Are your shareholder assets held in trust? Well, why do they ask that? Who cares if the shareholder's assets are held in trust? They're going to seek personal indemnity. So they want to know, is your personal indemnity, is all your assets in a trust? Because guess what? Your trust is going to have to indemnify as well. If it's all in a trust, you're not trusting, worth anything. Is there a continuity plan in place? You know, is there a formal buyout plan in place? Tell us some affiliated companies you've worked with. We're not going to go over all this stuff, but it looks pretty daunting, but it's not that bad. You know, you'll actually learn a lot about your company while you're filling one of these things out, and you might come to a question and say, gosh, never thought about this. And then, name some suppliers you've worked with. Name some architects and engineers that you've worked with. Name 5 subcontractors you've worked with. Have you had bonds in the past? Look at this question. Name of your surety, how long, and why did you leave them? Insurance doesn't care why you left them. Bonds say, why'd you leave the last bonding company? That's going to be the first question. They're not going to say, oh, we'd love to bond you. This sounds great. You're our new prospect. They're going to say, well, You had a great relationship with CNA. Why'd you leave them? They're going to say, well, gosh, we were looking for a better rate. And they'll say, well, good luck. And then some miscellaneous questions, then comments. Tell us anything that we didn't ask. Tell us why. What's your unique capabilities of your company? Tell us why we should bond you. Tell us what makes you tick. And we're going to get through this quick. I promise we're almost done. This is something I put together this morning. Underbillings and overbillings. We're not going to read all this, but underbillings are basically cost in excess of billings. And underbilling is going to show up on your financial statement as what? Underbilling is going to show up as an asset, right? A current asset. Well, when you show a heavy piece of current assets being underbillings, that might not be the best thing in the world. Because the surety is going to say, well, why are you working for free for this contractor? Why aren't you billing them on time? There's costs associated that you can't bill for. What's the deal? Underbillings are the first example of a contractor that is of contractor failure. I'm not trying to scare anyone that's underbilled right now, but if you look at the history of contractor failure, every one of them has huge underbillings left on there. That just means, well, gosh, we had a lot of work that we did, unfortunately, we couldn't bill for. So it cut right into their cash, right into their capacity, right into their working capital. Underbillings can also indicate poor estimating or poor job costing. Gosh, we didn't know we had to, pour 75 yards of concrete around it. We didn't know that. We should have probably bid that in there because we can't go and charge for it now. You're not going to get a change order for it. So we can't bill for it because it wasn't part of the initial contract. So unfortunately, we're going to work for free on this part. There is reasonings for underbillings that could happen. Just begun on December 5th. The financials come out on December 31st. The work performed in 26 days. So there are going to be some times where you are going to have to work for free, and that's okay. But rarely, and I've highlighted this, I bolded it, I hope you guys can see it, there are rarely good reasons for underbilling. It's common to see high underbillings in a failed contractor's balance sheet. Underbillings can create decreasing working capital. You're using your own money to finance a project. Use the contractor's money to finance the project. Use the owner's. Overbillings, billings in excess of cost. You can try all you want. ODOT's not going to let you do it, but you can try with some of your generals. Overbillings can be good because you're working on their money. They're financing your project. You're working free. You can get too overbilled on a project, and they call that job borrow. Sureties will ask, why are we job borrowing? Are we using money from contract A and job A to pay for contract B that might be having a little bit of trouble? You better have the cash to show why you've overbilled. And if it's because, hey, I got a trade discount on buying, this material. I got, 2 net 10 to buy this material. So guess what? I overbilled to go and buy this to catch a discount. Good job. Perfect example. Show them the invoice that you went and bought that. Like I said, they can come to your advantage at times, such as financing the project yourself instead of having to pay interest to creditors. That's kind of like taking terms. It's difficult to justify high overbillings, though, and it gets contractors into trouble during slow economic times. If you've really, really overbilled a project, sureties are going to ask. What do you think?
Yeah, thanks a lot. No, it's just like they say a pyramid scheme. You're taking from A to pay B, and then once you end up paying B, or if B goes away, what do you got then? They're going to ask the question.
This is gold right here.
Yeah.
And this is difficult. This is a little bit confusing. But if you can keep a good, and this is one that we've built for our clients here, and it's got some moving parts to it. But if you can keep a good job schedule, then it's going to help you with your accounting. It's going to help the surety. It's going to help everything going forward. Whether you bond projects or not, always have a good work in progress schedule.
Actual jobs, right?
Yeah. Smooth Sailing Parkway, Underbillings Bridge, and Overbilled Park are 3 different jobs that we've got. And fortunately, they all were $500,000 jobs. I don't know how it worked out like that, but they were. You can see on Smooth Sailing Parkway, the contract